Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and there is a lot to break down today, honestly.
There really is. I mean, imagine you're a home builder, right? And your building materials just triple in price overnight.
Oh man, that's a nightmare scenario.
Right. But if you're sitting on a massive pile of cash, you complain about your margins, obviously, but you keep building.
Yeah, you have the buffer to handle it.
Exactly. But if you're already, stretched super thin on credit, you don't just complain. You have to halt construction entirely.
You might even go bankrupt.
Right. And right now, the global economy is kind of splitting into those two exact camps.
It really is. It's this massive divide.
And the crazy thing is, the catalyst driving that split is completely misunderstood by most people. Which brings us to the mission for today's deep dive.
Yeah, because we really need to clear up some of this confusion.
For sure. If you are a beginner investor out there trying to make sense of the U.S. economy, especially, navigating the broader economic landscape under the current Trump administration, there are these two dominant, highly confusing narratives floating around right now.
Two very loud narratives.
Yeah. So first, we're going to look at what the Federal Reserve is really doing with its latest technical liquidity moves.
Because, spoiler alert, they aren't tightening, but they aren't printing free money either.
Exactly. And second, we are diving into the hidden, cascading economic shockwaves triggered by the conflict in the Middle East.
It's less about a sudden global crash and more about this slow-moving crisis.
Right. So by the end of this conversation, you'll have a much sharper, reality-based understanding of why interest rates and global markets are behaving the way they are right now.
We should probably start by tackling that first narrative, right? The one about the Federal Reserve.
Yeah, let's do it. Because looking at recent analysis, there's a headline that has everyone completely confused.
Oh, the New York Fed announcement.
Yes, exactly. The New York Fed just announced a reduction in its short-term Treasury purchases.
Right, the Reserve Management Purchases, or RMPs.
Right. They brought them down from $40 billion a month to $25 billion for the mid-April to mid-May period.
And the market reaction was it was completely all over the map.
I know. I was looking through the data, and half the financial world seemed to panic, shouting that, the Fed was draining liquidity and tightening the economy.
While the other half was cheering.
Yeah. They were like, wait, the Fed is still buying $25 billion. They're printing money again.
Which is wild because looking at the actual mechanics of this, both of those extreme reactions seem, well, completely off base.
Totally off base. Why do you think people are getting it so wrong?
Honestly, it's because people are confusing technical plumbing with broad economic policy.
Okay, break that down for us. What do you mean by plumbing?
Well, let's look at what actually happens during the April tax season. When millions of Americans and, huge U.S. corporations pay their tax bills, that money doesn't just sit around in the economy.
Right, it goes to the government.
Exactly. It physically leaves the commercial banking system, so places like Chase or Bank of America, and gets transferred into the government's account at the Fed.
Which is called the Treasury General Account, right? The
Yeah.
TGA.
Spot on. The TGA. So paying taxes literally drains physical cash reserves out of the commercial banking sector.
It's like a massive vacuum.
A huge vacuum. Hundreds of billions of dollars just pulled out of circulation very rapidly.
Wow. Okay.
Now, the Fed obviously monitors the level of cash reserves left in the banking system. And back in late 2025, they realized those reserves were transitioning from what central bankers call abundant to merely ample.
Okay, let's pause right there. Let's define those terms for anyone new to this, because central bank jargon can be incredibly dense.
Oh, it's the worst.
Yeah. So what is the practical difference between abundant and ample?
Okay, so abundant means banks have trillions of dollars in excess cash.
Like more than they know what to do with?
Exactly. They don't even have to think about liquidity. Everyone has plenty of money to settle their overnight transactions.
Okay.
And ample. Ample means the banking system still has enough cash to function. But that safety cushion is, it's shrinking.
It's getting a little tight.
Right. And if that cushion gets too thin, banks start hoarding cash. They stop lending to each other overnight.
And the financial plumbing basically seizes up.
Exactly. We actually saw this happen in 2019 during the repo market crisis.
Yeah.
And the Fed, they want to avoid a repeat of that at all costs.
Okay, let me test an analogy on you to make sure I'm mapping this out right. Tell me where I get this wrong.
Go for it.
Let's think of the commercial banking system's cash reserves like a car's gas tank.
Okay, I like it.
And the April tax paying season is a massive fuel-burning road trip.
Yes.
So The Fed looks at the dashboard, sees the gas tank is moving from full, which is abundant, down to half empty or ample. So to prevent the car from stalling out on the highway like it did in 2019, the Fed starts pumping $40 billion a month into the system to top off the tank before the tax season road trip begins.
That analogy holds up perfectly. That's exactly what they did.
Okay, so then the recent headline of dropping from $40 billion down to $25 billion.
That simply reflects the fact that the hardest part of the tax season is over. The hurdle is mostly cleared.
So they just don't need to pump gas at maximum speed anymore.
Precisely. They are easing off the pump, but they aren't slamming on the brakes. And they certainly aren't revving the engine.
So this has absolutely nothing to do with quantitative easing.
Not at all. And that's a huge takeaway for you as an investor today. You have to distinguish between operating liquidity and macro liquidity.
Operating liquidity being the gas tank.
Right, making sure the plumbing works so transactions clear. Macro liquidity, like quantitative easing, is when the Fed intentionally floods the system with cash and buys long-term bonds.
To, like, push down mortgage rates and boost the stock market.
Exactly. But the Fed is just maintaining the plumbing right now. They're doing the former, not the latter.
Okay, that makes so much sense. But that leads me to a pretty glaring question.
Let's hear it.
If the Fed is just quietly managing the gas tank behind the scenes and keeping short-term funding stable, then why are U.S. bond yields spiking? Like, why is the broader market so incredibly volatile right now?
Because the bond market is reacting to the gas pump, not the gas tank.
I'm interested. What do you mean?
Well, looking at the data, the real culprit causing this volatility isn't the Fed's $25 billion adjustment. It's a massive repricing of inflation and oil.
Right.
For the last year or so, the market assumed inflation was defeated and the Fed would cut interest rates rapidly.
Yeah, everyone was betting on rate cuts.
But now the market is waking up to this harsh reality that inflation is sticky. We're even hearing projections that if oil stays high, rate cuts might be pushed out all the way to 2027.
Wait, 2027? Waiting until 2027 for a rate cut is, I mean, that's a lifetime in the financial markets.
It forces a total recalibration of how people invest. And the hard data backs up this fear, too.
What data are we looking at specifically?
Take the March Producer Price Index, the PPI.
Okay, so wholesale inflation. The costs businesses face before it reaches us, the consumers.
Exactly. It jumped 4.0% year over year. That is the biggest annual rise in 3 years.
Wow. Let's dig into that 4.0% number, though, because I assume some sectors are driving it way more than others, right?
Oh, absolutely. Energy is the main driver here. In a single month, wholesale energy prices jumped 8.5%.
In 1 month.
Yeah. And gasoline specifically surged 15.7%.
That is massive.
It is. And because of this resurging inflation, the U.S. two-year yield is up about 40 basis points since late February.
Wait, let's translate basis points for anyone new to tracking bond yields.
Good call.
Yeah.
A basis point is simply 1/100th of a percentage point.
Okay, so 40 basis points means the yield on the 2-year Treasury went up by 0.4%.
Correct. And in the bond world, a 0.4% jump in just a couple of months is a really aggressive move.
But I kind of have to push back on the sentiment here, though.
Okay, what are you seeing?
If things are so tense, if inflation is running hot, and the bond market is basically throwing a fit because rate cuts are delayed until 2027, why is the stock market relatively calm?
That's the big question.
Yeah, like the S&P 500 recently recovered to almost pre-war levels. Why the huge disconnect between stocks and bonds?
Well, you have to look at the underlying mechanics of what a stock actually is versus what a bond is.
Okay.
Equity stocks are a claim on nominal earnings. Think of a major tech company, right?
Sure.
If inflation drives up the cost of everything by 10%, that company often has the pricing power to just raise its software subscription prices by 10%.
Oh, right. So their raw nominal revenue just goes up.
Exactly. It absorbs the shock of inflation, and the stock price, stays afloat.
So that these large cap tech companies are basically acting as a giant shock absorber for the entire S&P 500 index.
For the major indices, yeah, mostly. But if you look over at the bond market, there are no shock absorbers.
Because a bond pays a fixed yield.
Right. Let's say you buy a bond that pays exactly $5 a year. If inflation surges, the real purchasing power of that $5 is just destroyed.
You can't just raise the price of your bond payout. You're locked in.
Exactly. So bond investors immediately demand higher yields on new bonds to compensate for that inflation risk.
Yeah.
They're waking up to the reality that U.S. interest rates are going to stay higher for much longer.
Higher for longer.
Hmm.
Okay, so the stock market is looking at AI and corporate profit margins, while the bond market is staring directly at the reality of inflation and oil.
Which brings us right into the second major narrative of this deep dive.
Right, the global picture, the geopolitical shock in the Middle East. Because if oil is the main reason U.S. inflation is staying sticky, we have to look at the source.
And when people hear Middle East conflict and oil spikes, anyone who knows their history immediately pictures the 1970s.
Oh, yeah. Long lines at the gas station, a uniform global economic crash, just misery everywhere.
But according to the research, that is not what's happening today at all.
So how is it different?
Today's situation is a highly asymmetric shock. It's not hitting the global economy evenly in the slightest.
Let's explore that asymmetry. Like, how does it actually break down?
Well, you have wealthy, energy-producing countries like the U.S., especially given its strong domestic production right now, or nations in the Gulf.
Right.
They are buffering this shock reasonably well. I mean, it causes some domestic inflation, sure, but it isn't an existential crisis for them.
Okay, but on the other side.
On the other side, you have low-income emerging market countries that have to import all their energy. For them, this is absolutely devastating.
What does devastating look like in terms of like the actual growth numbers?
Well, the IMF recently revised its 2026 global growth forecast down to 3.1%.
Okay.
But the crucial variable in their model isn't just the absolute price of a barrel of oil today, it's the duration of the spike.
So how long it stays expensive?
Exactly. If oil sits at $100 a barrel for a prolonged period,
Yeah.
global growth drops to 2.5%.
Wow.
And if it spikes to the $110 to $125 range and just stays there, global growth falls to 2.0%.
And a 2.0% growth rate is essentially the threshold for a global recession, right?
Yep.
Considering population growth.
It's bad. Furthermore, the International Energy Agency, the IEA, just released this staggering data point.
What did they find?
They completely flipped their 2024 oil demand forecast. They originally predicted global demand would increase by 640,000 barrels per day.
Okay.
They just revised that to an 80,000 barrel per day decrease.
Wait, really? Demand is shrinking.
Yes.
That means prices got so high that vulnerable economies simply stopped getting it.
It's demand destruction in real time. They literally cannot afford the energy required to run their economies.
This brings me right back to that home builder scenario from the beginning of the show.
Yeah, that analogy fits perfectly here.
Right. So we have the wealthy home builder representing the U.S. or strong energy exporters. Materials triple in price. They groan, it hurts their profit margins, but they have the credit lines. They have the cash reserves to absorb the cost, finish the house, and eventually pass the expense on to the buyer. They survive.
Project continues.
But the lower income builder representing the emerging markets, they face the exact same price spike.
But their credit line is already maxed out.
Exactly. They have no fiscal buffer. They don't just complain. They lay off their workers and they walk away from the foundation. The project just dies.
That is the exact dynamic playing out on a sovereign level right now. And the tragedy for developing nations is that it isn't just, gasoline getting too expensive for drivers.
Right.
It's a multi-stage domino effect. And recent analysis shows that the most dangerous domino isn't fuel for transportation.
What is it then?
It's fertilizer.
Fertilizer. I think a lot of people miss that connection entirely. Walk us through the mechanics there. Why does a geopolitical conflict affecting oil and natural gas immediately trigger a fertilizer crisis?
It really just comes down to basic chemistry.
Okay.
Natural gas isn't just used to power the lights at a fertilizer factory. The methane inside natural gas provides the actual hydrogen molecules necessary to synthesize ammonia.
Oh, wow. Okay.
And ammonia is the foundational building block for nitrogen fertilizers, like urea. If you don't have natural gas, it is physically impossible to manufacture the fertilizer.
So when energy shipments are disrupted or just priced totally out of reach, the fertilizer supply chain just evaporates.
Exactly. And for developing nations, a shortage of nitrogen fertilizers is a much more immediate and terrifying threat than the price of crude oil.
Because it hits their food supply.
Yes. You combine the massive cost of natural gas with the fact that these shipments rely heavily on choke points like the Strait of Hormuz.
Right, which is obviously very tense right now.
And you have a recipe for an absolute agricultural disaster.
Because agriculture operates on these strict, unforgiving seasonal timelines. You can't just delay planting by a few months until fertilizer prices come down.
You really can't. If farmers in developing nations miss their short planting windows because fertilizer is too expensive or just unavailable, their crop yields plummet.
Yeah.
And the scary part is that you don't feel that impact immediately. The pain is delayed.
Right. It takes time for crops to grow or not grow in this case.
Exactly. But months down the line, at harvest time, that missing fertilizer translates directly into severe food price spikes and massive food insecurity.
And we are seeing warnings that regions like Sub-Saharan Africa and South Asia are incredibly vulnerable to this exact sequence right now.
Highly vulnerable.
So we trace the dominoes. An energy shock causes a fertilizer shortage, which causes crop failures, which causes food prices to skyrocket.
Yep.
But when citizens can't afford basic food or fuel, they look to their government for help. So why can't these emerging market governments just step in and subsidize the costs?
Because the final domino has already fallen.
Which is
the fiscal survival of the government itself.
Oh, wow.
These emerging market governments are already drowning in debt. Look at the data for African nations. Their debt servicing costs, meaning just paying the interest on the money they've already borrowed, have skyrocketed.
Just the interest.
Just the interest. In 2017, debt service took up about 9% of their government revenue. Going into 2025, that number is nearly 18%.
Nearly a fifth of their entire national income is going just to pay interest on old debt.
Which means they have zero fiscal space left in their budgets. They simply do not have the money to step in and absorb these massive new food and energy costs for their citizens. The fiscal buffer is gone.
Man, that is bleak. So if I am a beginner investor sitting here in the U.S., looking at my portfolio and trying to make sense of international markets, what is the actionable takeaway here?
It's a tough environment.
Yeah. How should we evaluate emerging markets when the fundamental landscape is this treacherous?
So it really requires changing your analytical lens. You have to look past the top-line GDP growth headlines.
Okay. What should we be looking at instead?
You need to look at a country's specific energy import structure and their fiscal balance sheets.
Like, how dependent are they on imported energy?
Exactly. Do they have cash reserves?
Yeah.
And interestingly, major institutions like the IMF and the World Bank are explicitly warning these vulnerable countries not to use broad, sweeping subsidies to try and fix this crisis.
Wait, really? Why would they warn against that? Because from a humanitarian perspective, wouldn't subsidies help the citizens afford basic food and gas in the short term?
In the short term, yes, absolutely. But in the long term, broad subsidies will just bankrupt these countries entirely, leading to a much deeper systemic collapse.
Right, it just delays the inevitable.
Exactly. So the recommendation is to use highly targeted temporary relief only for the absolute most vulnerable populations rather than subsidizing fuel for the entire country.
But implementing targeted relief while letting fuel prices rise for, say, the middle class, that sounds like political suicide for those governments.
Oh, it is incredibly politically painful. There will be protests. But from an investment standpoint, the countries that maintain their fiscal discipline, when it's politically unpopular, those are the ones that will survive this.
That makes a lot of sense.
As an investor, you are looking for countries that earn a trust premium from the market because they enforce strict fiscal rules.
Right. You want to avoid the nations that are just bankrupting their treasuries, trying to artificially suppress the reality of global energy prices.
Exactly.
Wow. Okay, let's synthesize everything we've covered today because we've mapped out a really complex web connecting the plumbing of the U.S. banking system all the way to global agricultural choke points.
It's all connected.
It really is. So we started with the Federal Reserve, and we learned that their latest move reducing Treasury purchases from $40 billion to $25 billion is simply routine maintenance.
Just keeping the gas tank topped off.
Right. They are managing the mechanics of the April tax season, keeping the banking system's operating liquidity ample. They are definitely not signaling a new era of money printing or macro liquidity.
The plumbing is safe, but the macro environment is tightening.
Yes. Then we explored why the U.S. bond market is basically sounding the alarm. It isn't the Fed's plumbing, it's the reality of sticky inflation and high energy prices pushing rate cuts way out to potentially 2027.
Higher for longer.
Higher for longer. And while the U.S. stock market is somewhat insulated because tech companies can just raise their prices to protect nominal earnings, fixed yield bonds are taking a direct hit.
They don't have that shock absorber.
Exactly. Finally, we looked at the asymmetric global shock. The U.S. buffers the pain, but emerging markets are facing this catastrophic domino effect where high energy prices destroy the fertilizer supply, which inevitably leads to a massive food and fiscal crisis.
It is a profound reshaping of the global economic landscape, basically dividing the world based purely on fiscal strength and debt levels.
It really is. And that leaves us with a final, thought-provoking question for you to mull over as you review your own portfolio.
It's an important one.
We've discussed how the U.S., much like a wealthy homebuilder, is buffering this shock for now. But if these low-income emerging markets are forced to completely drain their budgets just to secure basic food and fertilizer, and their economies stall out completely,
Yeah.
how long before that severe financial distress washes back onto the shores of the resilient U.S. economy? Whether through broken global supply chains or massive sovereign debt defaults, the global economy is deeply interconnected. A crisis on one side of the world rarely stays contained forever.
It's definitely something to watch closely.
Absolutely. Don't forget to subscribe and hit that like button.